All right, what's up, y'all? Listen, I'm going to go through sort of our technical assistance or TA to loan readiness tool that we use here at my CDFI here in Memphis, RCC. And so this is sort of a new migration that I'm working on with my loan origination software provider to actually include as an automated system. But this is actually done in Google Sheets. So I'm going to get right to it. So what you'll see here is sort of a model of how we evaluate technical assistance education for entrepreneurs. So Black entrepreneurs here in Memphis that are in sort of emerging market areas, right? Those areas that have been somewhat disinvested that we're looking to reinvest in and revitalize by building up entrepreneurship. So here in this example, you will see our people here, Klondike Grocery and Meats. This is just a dummy made up business here. John and Brianna Banks, they have lease space over on Jackson Avenue, and they're needing $35,000. So what you see in the model here is we've sort of scoped out, and there's some, of course, just basic sort of Excel formulas in calculating based on a 36-month term, an interest rate, which we'll get to here in a second. The monthly payment, what an interest-only payment looks like, which I'll get to, the origination fee, their credit score, and then sort of their loan purpose. And let's just say today it is equipment purchase for their restaurant, right? All right, so the categories, and I'm gonna jump around just a little bit, but only to help you sort of understand what's sort of going on. So you've got 7 categories here: business structure, financial records, business revenue, access to capital history, marketing and sales, commitment to TA needs, and personal credit history. Those are sort of the categories that we're looking to evaluate to determine if someone is sort of capital ready, right? Meaning capital ready in this instance, meaning ready for CDFI capital or community development financial institution type capital. So this is prior to going to any other lending institution, right? And so each one of these categories has a weighted average, as you see here, right? So you can see for each one, the highest one, of course, being credit history, right? Because it has some of the most impact in terms of access to credit and somewhat in that traditional sense, right? So with each score, right, through this evaluation, so questions are asked of the entrepreneur, and then we're able to determine this. So business structure is, sort of your legal structure. Do you have a tax ID number? Do you have your business license? Are you're sort of registered? That sort of thing. So it ranges from calculates a red, if you have sort of no structure or sort of informal; yellow if you're registered but missing some things; and then green if you're sort of fully registered, you have your tax ID number, you have your business license, right? So what I've done here, for the sake of time, I'm not going to go through each one, but the red, yellow, green determines sort of the weight, right? So here you have sort of the calculation for the weighted score, right? So red is sort of 0%, yellow is 50% in that category, and then green is 100% of the weighted score, right? So if you know the math, green in this instance, of course, is 100%. Yellow is 50%, so 50% of 15 is 7.5. And then red, of course, is 0, so 0% of 15 is 0, right? All right, so in this instance, this particular prospect, John and Brianna Banks, have scored in these areas, right? They got a green in their structure, their financial records, right? They have some tracking, but they're sort of inconsistent, right? Their revenue, they're between sort of 5,000 and 25K in a year. Access to capital, they've put some personal investment in, but they've never been either approved or applied for any sort of capital outside of that. From a marketing perspective, they have sort of a basic marketing plan, but there's really no consistency there. Their commitment to education or the technical assistance, they're willing to learn. There's some gaps that they have, obviously, but they're willing to learn. And then from a credit perspective, again, they're a 575, remember, right? So if you remember that, they're a 575. So that's putting them in the yellow in terms of this, because the range here is, as low as 550, so 550 to 599, 600 to 659, and then 660 plus is the green, right? So when you take into account the total of these weighted calculations, right, you get a 57.5. So what does that mean, right? So let's look at the final rating. So this final rating here, this 57.5, here's sort of the grid for final rating, right? So a 0 to 49% is a red, meaning this is a high risk business. They really need full sort of technical assistance education before getting any funding. These are folks that need a little bit of work, right? If you score 50 to 74%, you're in the yellow, right? So you're a more moderate risk. You still need some technical assistance education, but you're a little bit closer. And then green, which is 75 to 100%, that's in the green. That means you're a lower risk. You're essentially ready for funding as it relates to us, right? Doesn't mean in the whole world, right? This means as it relates to us, you're ready for funding, and of course you still need some light sort of education or TA and maybe in some areas, right? Okay, now let's go down to the scoring table, right? So this is sort of breaking down what I was doing in the drop-down boxes. So for each category, you can actually see here what constitutes red, what constitutes yellow, what constitutes green, and of course then the weight. So this is for when my team is sort of going through and these conversations are taking place and you're determining the red, yellow, or green, all right, based on where they are, based on a review of their business plan, based on again, the conversations, based on the financial information, right? Do they have a balance sheet income statement or not? Are they using, Cash App and Venmo and some of those things, or they're using a personal account, right, to operate their business? All right. Now, let's sort of get over to the underwriting review, right? So underwriting review is taking a little bit different sort of course from this. It's still the red, yellow, green, as you see here, right? But they're also, the ratings are a little bit different, right? So you have the readiness score, remember from before, the screen that was just on. So that couple with that business, their actual score was a 57.5, right? So a green gives you 3 points, yellow gives you 2 points, red gives you 1 point. And then I'm gonna go through the rating and how we make decisions, right? So their readiness score is basically what's their readiness from this technical assistance process that we just went through, right? Where are they? They were 57.5, that's 2 points. Personal credit, remember they were 575, right? So the combined score, well, that falls in the red, right? Between 550 and not 550 to 559, 599, right? Caught myself there. So that's 1 point. Debt service coverage, right? So you hear about that, DSCR, debt service coverage ratio, right? What does that mean? Well, I've got the definition right here. All right, so right here, you'll see debt service coverage ratio is net operating income divided by total debt service. So remember, in business, we analyze things annually, right? In consumer, like debt to income, DTI, it's the same sort of calculation, but the debt service is monthly and the operating income is monthly, right? So that's like your credit cards, your consumer loans, things like that. But in business, we calculate things annually. So it's essentially your net operating income, right? Net operating income then is made up of your revenues minus your expenses, right? So your net operating revenues minus your expenses, including taxes, all those type of things. Total debt service takes your annual payments for all your debt. So all your different loans that you have or may have for your business, right? It takes those plus the new payment, right? So let's go back real quick. So what is the new payment? Let's go back to this readiness assessment, right? So the new payment is proposed, right? A little over $1,000, less than $1,100 a month, right? You see that, that's the principal and interest payment. So then when you multiply that by 12, you probably get somewhere around $13,000 a year, right? That's what is included in this total debt service. So it's calculating your existing payments that you're making on debt you already have, plus the new principal and interest payment on what you're proposed, right? So that gives you a ratio. What that ratio is telling you is for every dollar of debt that you have in the business, how much income do you have to service that debt, right? Typically what you'd like to have is above a 1.25. What that means is for every dollar of debt that you have at least $1.25 to cover that debt, right? In their case, right, let's look at the math real quick. So they have operating revenues of $591,000 a year. That comes from the income statement and their tax returns, right? Schedule C on their tax returns in this case. Operating expenses, $446,578. That also comes from the income statement, and it can come from bank statements, right? To get sort of the everyday expenses, right? When you subtract those two, you subtract the 591 and the 446, you get 144,422, right? So that's your net operating income, right? Your debt service, they have $126,450 in payments, which includes that new payment. Remember, this is annual, right? So when you divide that, so you divide 144,422 by 126,450, you get a ratio of 1.14. That means for every dollar of debt they have $1.14 to service it. So that's what you see here in terms of the actual, right? Well, again, we like to see at least $1.25, or I'm sorry, 1.25 or greater. And in the green scenario, we like to see 1.5, right? So that 1.14 gives them 1 point. All right, so time in business, right? Obviously, the longer someone's been in business, the better. The more stable that they are, the less of a risk they are. We like to see, you see the ranges here, red being less than 12 months, all the way to 24 months or greater is in the green. This particular prospect is at 9 months, so that's another 1 point. Profitability trend, right? So they're actually breaking even, so that's a 2. That's 2 points. Breaking even's a yellow. If they're posting losses, right? They're constantly showing losses on tax returns, multiple years, that's a red. If they're showing 2 years or more of sort of profitability, that means they're paying taxes. That means they're not getting their loan from the IRS. They're more likely to get it from me, right? If you're always posting losses on your tax returns, I always joke and say, you got your loan from the IRS, and they're not a great lender. Collateral. So collateral is a secondary form of repayment. So keep that in mind. I don't want the property. I don't want the equipment. In this case, that's not what I want. So just having collateral is not enough. I want cash flow. Loans get paid with cash flow, right? But collateral is secondary. In their case, they can personally guarantee it, but they don't really have, really a qualified, asset outside the equipment, right? And restaurant equipment is pennies on the dollar when you have to go sell it. If they're in the red, if they have no collateral, if they have sort of a qualified asset, they're in the green. In this case, they're a 2, right? Personal guarantee. Then technical assistance engagement, a little bit more of a subjective type calculation. Are they active? Is there some participation or a little to no participation? They're an active participation in this example, so they get 3 points, right? So all these points total up here to 12, right? From these 7 categories, right? They total to 12, and then you divide that out, so you get your simple average of 1.71, right? So here's sort of the rating of that on how we're sort of determining from that calculation what we recommend. This is recommendation. This is not guaranteed. This is not on the tablets that Moses brought down from Mount Sinai, right? The 10 Commandments. This is recommendation, right? So if this score, this 1.71, were, if this were to be 2.50 or greater, it would be in the green. That means we would recommend an approval from our team. If it falls between 1.8 and 2.49, it's in the yellow. That means a yellow, and we've got some definitions of that, but that means we're going to review that, right? And we could determine to approve it or counter offer it or decline it. And then if this score is below 1.8 or below, it's in the red, and we recommend a decline. Doesn't mean 100% we're going to decline it. And when we decline the application, not the people, right? So in this case, 1.7 actually is in the red. I'm not sure why they have that way. So that's actually in the red, okay? So this would be a recommendation for a decline, right? Now you have to go back to the technical assistance that we were talking about, the education, right? What do you do? So it's not just do you decline the application and walk away, right? What do you do next? So what you do next is sort of the checklist, right? So here, what are the things that they need to work on? Credit history is one, right? Because see, go back to our assessment. Let's sort of get this together. So their credit is a 5.75. So hold on a second. Did I do that right? I don't think I did that right. 5.75 is actually red. I'm sorry. I screwed that all up. 5.75 is actually red, right? So in terms of the final rating is actually 45%. So on the checklist, credit history needs to be marked as red, not green, right? Because if you look at the rating for that, which we need to update this. So if you look at the actual sort of the rating that comes over, was at 0%, right? TA commitment needs was a yellow, marketing strategy was a yellow, access to capital was a yellow, business revenue was actually a yellow over there, right? Financial records was a yellow, and then business structure was a green, right? So now, how do you prioritize this? You're prioritizing what's in the red. Remember, credit history has the highest rating. It weight in terms of weighting. So that would be where you'd want to start, right? So you want to be working on, so that's where we work and connect with our partners to help this particular couple work on this. It's Brianna, not Tam. Correct that. All right, so credit history is in the red. Then you've got this sort of slew of yellows, right? So now they have different weightings, right? So financial records and revenue are a little bit higher than these others. So now you want to get to how you're sort of going to prioritize these. Your structure's in the green, so you may not have to, that may just be an oversee that, but you may not have to spend a whole lot of time on it, right? So this checklist goes back to, in this case, John and Brianna, and then we're connecting them with the partners. So as these things improve, right? So let's go back to our sort of model here. So as these things improve, right, you start getting greens, they get their bank account stuff together, their revenue goes up, right? They're able to receive some loans and grants. They get their marketing plan in order, right? They become, they develop strong business acumen by spending time with us and the partners. And then a big piece is they get their credit up. So let's just say they get now above that 660 bar. Man, now they're rocking and rolling. They're 100%, right? And we're going, actually before that, but once they get to sort of the green overall score, we're going. And man, we're rocking and rolling from there. Then the opportunity is once they're able to sort of successfully do a loan with us. So let's just say we do that now we do the loan at 5%. They're in the green, so we do the loan at 5%, right? So $35,000, 36 months, 5%. That's a monthly principal and interest payment of $1,048. I may say, hey, for the first 3 months, why don't you pay me interest only? That would be $145.83. They pay us a 3% origination fee. Their score now is, let's just say 700, and they purchase the equipment, all right? Then they graduate from us, right? The idea is a CDFI, just because we're nice and available and not, pricks like some of the other lenders, doesn't mean you have to avoid them. As this business grows, right, you're gonna need larger capital, right? CDFIs don't have unlimited capital, right? We're not banks. We don't have your deposit money, right? And that sort of thing. So that's sort of the piece that now we connect you with partners and other ways, other forms of raising capital, whether it's Reg CF, whether it's revenue based, whether it's in the bond area. There's other areas to be able to raise capital. So hope this was helpful. I tried to keep this under 20 minutes, so it looks like I'm gonna be successful. But let's get back to our next steps here in the conversation.